All right, so let's get into it, and a warm welcome back to Martin Crabb from Shaw and Partners. Martin, good to see you.
Good to be here.
Yeah.
Welcome.
So, what do you make of the market at the moment?
It's a bit of a blur day today, wasn't it? It started pretty good, but it looks like almost people were having a bet that it was going to be unchanged on the day. They were trying to get it right to close on.
Well, we can call it
zero
flat, can't we?
unchanged.
Really?
Yeah. So on the macroeconomic front, the big news is obviously the China trade data. That was way different to what people thought. I mean, monthly trade data can be quite volatile, but their trade balance was supposed to be almost $60 billion US, and it came in under 20. So it was a big difference. Just goes to show how strong their economy is. Imports are up almost 40% a year. So that was a big mover. But yeah, on the stock front, this is the sort of what do they call it? The doldrums, where there's no wind and you're just sitting in the water before reporting season. So it sort of kicks off tonight with the US banks. And then we get the quarterly production results from the miners, which I think kicks off with Whitehaven tomorrow, then Alumina Friday, and then we get into the big miners next week. We don't really have a lot of quarterlies. Most of our companies just have annuals and interims, but there are a few quarterlies. But yeah, so the only thing I really saw today was the Zip quarterly revenue numbers, which looked amazing.
Yeah.
I mean, the market's pretty bullish on that stock, but they came in even stronger than what the market thought. So
they did. There's some of the Zip numbers on the screen, and as we're heading into the close, Zip is actually up 18%.
Wow.
Today, and that dragged up some of the other buy nows on the back of that as well.
Do you think they're actually now with those numbers, they're starting to prove a lot of the naysayers wrong, and like seeing the potential, particularly obviously in the States there?
Yeah, absolutely. It's a massive market and it's almost totally untapped. So Zip own QuadPay, which is a US player, and it seems to be growing faster than the other players over there. But even they've got, I think, they're on track to have 3 million customers. There's 350 million people in America. There's probably 200 million households that would qualify for buy now, pay later. So they haven't even scratched the surface yet. And it does seem to be similar sort of dynamic than in Australia, where banks are happy to get out of the credit card business. It's just a terrible business. It's very capital intensive, and buy now, pay later is not considered credit because of its nature. So you don't need a bank there providing capital, etc. So it's a really good space for a disruptor to move into. So it seems that what is now almost very common in Australia, I think 1 in 3 people have got a buy now, pay later in account in Australia. If you run those numbers in the States, it's 100 million people. So it's a big market, and I think the market's now starting to get their head around that this is real and this is not just a fad, and this has got real legs.
Because you're saying here that Zip came in multiples of what you expected. Is it because the consumers are spending more, there's more customers, or just completely underestimated the impact of
Yeah, I mean, it's difficult because these growth numbers are astronomical, like 250%. So, you can be out by what seems to be a large number. We're out by 15%. We might have been 235 and they came at 250. They're still two very big numbers. So it's very difficult on a quarter by quarter basis to get the pace, because often it's driven by their marketing activity. So how active are they in signing up merchants? And then once you sign up the merchants, the customers follow. So it's difficult to get the pace on that. And it's also, in the States, obviously it's very patchy. Some parts of that economy are open and some parts are still dealing with the virus and the vaccine and so forth. So depending on which part of the country they're growing in, that can have an impact as well.
So do those numbers make you reassess perhaps some other players in the market, the afterpays for instance?
Yeah, well, I think it's one of those things where a lot of fund managers just buy the theme, and if you just buy the theme, you probably buy Afterpay because it's the biggest, it's the most liquid, and it's in the ASX 100, etc. There's then a long list of smaller players. Probably Zip's probably the leader amongst them. You've got OpenPay, you've got Sezzle. There's a number of Hum, which is the old what were they called before? I can't remember. Flexi Group, yeah, that's the old Flexi Group. So
FlexiPay.
FlexiPay,
Yeah.
Flexi Group before that. So they love a name change, those guys. Yeah, so you've got a handful of stocks there, and then there's some other ones that are in a similar space. So I think it's one of those rising tide lifts all boats sort of stories that people are looking at what Zip's doing and saying, well, that's the whole market's doing that. It's not just them. But I think the argument for Zip, or one of the arguments in favour of Zip, is it's trading at a big discount to Afterpay. So obviously Afterpay, it's up to $140 or something like that. It's had a pretty big re-rating already. Zip's got it. So Zip was $5, then it went to 14, then it went back to 10. It's probably 12 today. So they're not for the faint-hearted, these stocks, are they?
So what quarter are we talking about? Are we talking about March quarter?
Yeah.
Because US retail sales are out this week and the market's looking for 5.5, but one estimate is 8.5, because the first lot of stimulus checks boosted January.
Yeah.
But then these stimulus checks are multiples of the first lot. So US consumer, anything related to US consumer stocks must be looking positive.
Yeah,
surely.
I think it's a no-brainer. I think retail in the US and to some extent in Australia is a bit of a no-brainer. All of the surveys that we're seeing coming out, and there are some groups that do household surveys, just like the ABS does. So I saw one today that was very, very positive. So people are feeling a lot more relaxed about their job, and even the people that are on unemployment benefits. The government in the US is obviously clearly backstopping them for quite some time. And people have saved a lot of money. There's hundreds of billions of dollars sitting in bank accounts that weren't there a year ago because you can't go overseas. That's $60 billion a year in Australia. Everyone's sort of got the dividend check, they've raided their super, so there's heaps of money. Exactly the same situation in America. In fact, America, they've been locked down for longer. So there's this what they call revenge shopping. So people are just going to catch up. Things like autos, apparel, all that sort of stuff. Because again, it's difficult to spend on experiences, so people are spending on goods. So I think retail sales in America, will surprise to the upside. And it's like the reporting season. Analysts have got 10% earnings growth. It's probably going to be more like 20. So I think there's a fair amount of upside to earnings revisions on the back of that.
Bringing it back home, obviously some positive results just as far as those business and consumer surveys that we saw today. Obviously reflecting there's a lot of pent-up demand there in the system. Is that going to flow through as far as CapEx is concerned?
Yeah, I mean, that's the view. So the NAB business survey is probably one of the better followed ones, and there's lots of surveys out there, but that one's quite well followed. So that looked to be setting some records, and records not just in terms of how people are feeling now, because there's obviously a relief that we got through last year and now a vaccine's there and the world's starting to look a better place. But we're now willing to borrow and we're now willing to spend. So if you look at credit growth, I mean, everyone's talking about macro-prudential measures because the housing market's going nuts. If you look at credit growth, it's actually not picking up that much. Given how free and available money is, you can pretty much borrow as much money as you like for 2 or 3%. We're now starting to see boards just getting that courage to say, we're comfortable with the outlook, we should be spending. All of the CapEx stuff we put on hold last year, we need to sort of get that going. So there is definitely going to be a big uptick to the capital side of the economy as well as the consumer side. So it does look pretty good.
Speaking of pretty good, as you were alluding to earlier, US reporting season kicks off with the big banks. Will that put the focus back on our banks? Because our banks are looking in pretty good shape too.
Yeah, I mean, people try to draw a parallel, but they're really quite different beasts. If you look at the breakdown, the asset breakdown of things like Goldman Sachs and Morgan Stanley and JP Morgan Chase, they're not really retail banks the way ours are. So ours are basically savings and loans, right? They take household deposits and they lend to people for housing. So I think that'd be 70 to 80% of the Aussie banking sector. Then you've got some institutional banking. They're not really in investment banking. I mean, NAB do a little bit, CBA do a little bit, but they're mostly big savings and loans. Whereas you look at a Goldman's, it's not driven by that, or a Morgan Stanley, they're more driven by capital markets and what they call FIC, which is fixed income, commodity and currency trading. So they can have big swings in their P&L. So there really isn't a lot of read-through. And the only exception might be Macquarie. So Macquarie looks a little bit more like a US bank, and people will read through Goldman's definitely into Macquarie. So if Goldman's has good trading profits, et cetera, people will extrapolate that to Macquarie. So if we see good numbers tonight, you'll see Macquarie do well tomorrow.
Is the other key difference, US aren't big on dividends like we are here?
No,
Why is that?
I think it's something to do with the tax law. They have double taxation of dividends. So here we've got dividend imputation. So it basically says if the company's already paid tax, you get a credit for it. Whereas in America, if the company's paid tax, they don't care. You have to pay tax as well. So they're much more interested in doing buybacks because obviously capital gains are taxed at half of what income is.
Right.
So you'll see Jamie Dimon go for a buyback before you'll see him go for a high dividend payout.
Right.
Always fascinated me that because we love our dividends down here, and the
Absolutely.
US has no idea what a real dividend is.
I think
Certainly not live on them.
I think you're showing your age though too. Because
I
think
do that fairly regularly
I
on
don't
this show.
think, I don't think those new retail millennials are actually so interested in getting
No,
a
but
yield.
even they have to retire one day.
Put that off.
That's right.
Thanks for coming in, Martin.
Thanks,
Crabb.
Martin. Good
to
Always
be
a
here.
pleasure from Shaw and Partners.